Welcome to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, Chief Executive Officer of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics, a production of America's Talking Network. You can subscribe to all of our podcasts at americastalking.com. To support Everyday Economics, please make a tax-deductible charitable contribution by clicking the link in the show description. Oh, I'm fired up. It's great to see you. Recording this on January 29th, and I'm going to bring in my dear friend, Dr. Orphe Divounguy, PhD. Dr. O, it's Monday morning. It's early for you. It's early for me, but it's the start of a new week, and we got lots to talk about. Federal Reserve is going to get together. The Fed meetings scheduled for Tuesday and Wednesday. We're taping this on Monday. This is I would say an eagerly anticipated meeting among those paying attention. Fed funds rate. Heading into this year, Fed governors said, we anticipate we're going to make some cuts. The economy has done what it's done in the meantime. What do you think is going to happen this week?
I think the market is pretty set for no rate cut in January. The Fed funds futures is indicating that we will probably hold. The Fed will probably hold. The probability of the Fed funds rate staying in the current range is now 98%, which basically means nobody is expecting the Fed to cut this week. And I think that makes sense, right? So first, we had a GDP report last week showing the third quarter was much stronger than expected. GDP grew 3.3% in the fourth quarter. So much faster than what the Fed had initially anticipated in its summary of economic projections. And then, of course, you saw the stock market doing extremely well. You saw yields come down significantly from October. So there's been a lot of easing. Financial conditions have eased somewhat. And of course, a strong stock market, a strong labor market too. I mean, the labor market's been very good, very, very resilient. And with inflation coming down, that means real wage growth for households. You look at consumer sentiment, and consumer sentiment's improved tremendously entering into the new year. So you have all of those factors that indicate the consumer is very strong, and that really there's no reason really for the Fed to be worried, right? Of course, with declining inflation expectations comes the fact that the Fed is going to have to cut at some point, very likely this year. But January is not the month to do that. I think I've written about this a little bit. Policy is restrictive because we're seeing the slowdown, but acting too soon could undo much of the recent progress on inflation. And so that's kind of where I'm at. But look, I'll give you another interesting number here to watch out for that to me indicates that the Fed might just be very cautious, might stay on the sidelines and stay cautious because they're cautious. Core inflation, the Fed's preferred inflation gauge, went from 3.2% year over year in November down to 2.9% in December. Progress, right? But if you look under the hood, you look at the 6-month and 3-month annualized rate, right? You realize that basically at 6 months, we were down to 1.9%. In the last 3 months, they had slowed even more to 1.5%, right? But that in December, it ticked back up over 2%. And so you had a big slowdown. Most of the slowdown, I think, came from the October spike in yields. And then, of course, yields have come down. The stock market has roared. Consumer confidence came back a little bit stronger in December. You saw it in the retail sales number, much higher than anticipated. And so the uptick in December says, hey, we may be headed in the right direction, but we can't put our foot completely off the gas yet and even try to accelerate this thing. We have to be very careful. There's still a lot of upside inflation risk. And so that's why the Fed stays on the sideline.
Let me ask you a question. We've got about a minute and a half left. To the consumer, what does this mean to them for decisions they may be thinking about, whether it's buying a home or buying a car?
It means absolutely nothing. Nothing's going to change between now and next week after the Fed decision. I mean, potentially. I mean, yeah, I don't think, at some point I would have thought, okay, potentially the market could react by, with yields increasing, but not so much because it's really all priced in already. I mentioned earlier, Fed funds futures showing the Fed doesn't do anything this week. So really very much priced in. The market expects this. I'll tell you what, though, if we don't get more progress on inflation for the first half of this year, and if we don't get a rate cut starting in March or in June, right, in the first 6 months of the year, then yields will probably swing back up because I think the market's really out there expecting Fed cuts, at least 3 cuts this year. And so if we don't see more progress on disinflation, if we don't see the Fed cutting at least by June of this year, then it will hurt the consumer because things are going to get a little tight.
Well, appreciate your thoughts as always. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other high-quality podcasts at americastalking.com.
Audible is a great way to gain access to an ever-growing selection of audiobooks. They've got what everyone's listening to, bestsellers, new releases, that story you've been waiting for. Follow the link in our show description to get 30 days of Audible free.